Let's go straight to our keynote speaker to start us off. Our keynote speaker today is Sam Berridge from Perennial Partners. Sam is a portfolio manager and resources analyst at Perennial. Sam, welcome back, and please take it away.
G'day, Manny. Thanks very much for having me back on Share Cafe. I always enjoy giving a brief presentation. So, being that it is the beginning of the year, every man and his dog has chipped in with their sort of outlook statements for calendar 24. So, I think I'll probably add my 2 cents to that, keeping in mind that this could all change next month depending on what the data does. But certainly, this is how we're seeing things at the moment. So, if you flick over to the next slide and past the disclaimer and on to our commodity mix. So, I mean, investing in commodities is not a set and forget exercise. You do need to move things around. A few years ago, you could see we were quite solid in lithium and also in Aussie gold. But over the calendar 23, you can see we cut that lithium exposure back quite meaningfully. And we're just starting to, try and pick the bottom in that sector at the moment. But other than in lithium, our conviction calls at this point in time is in copper, uranium, which we've been long in for at least 6 months now, and that sort of uptick in uranium weight for the last month has been due to organic growth in the portfolio. We haven't been adding to positions; they've just been increasing in size by themselves. Also, a little bit of rare earths, which I'll touch on at the end of the presentation. And that bit of an uptick in energy services there is just from our holding in DUG Technology, which has been doing very well and growing organically. But moving on to onto the next slide, I figured I'd touch on uranium because there has been a bit of carnage in that space today and some news out overnight. So for those that haven't seen it, Cameco released their sort of calendar 23 production as well as their guidance for calendar 24. So guidance for 2024 was about 22.4 million pounds for Cameco's share. That was a bit stronger than the market was expecting. So I think the sell-off you're seeing today is not necessarily a reflection of a bearish data point. It's just a data point that the market was not positioned for. And the background to this is back in September of last year, Cameco held a site visit to its operations, attended by both the buy side and the sell side. And one of the key takeaways from that site visit was that the Key Lake mill, which had been struggling to ramp up to its to full capacity, was likely to continue to struggle, and that was placing some risk around calendar 24 guidance, or so the market thought. So just to put that in context, Cameco downgraded their calendar 23 production guidance by 8% in September of last year. They then missed that figure by a further 6%, partly attributable to this Key Lake mill. So looking forward to calendar 24, they're assuming that that Key Lake mill works perfectly, which, the market wasn't expecting that. The market was expecting a lower number, but the reality is I think it's probably going to be tough for Cameco to achieve that guidance, that 2024 guidance released today. And we could well have a repeat of the Kazatomprom announcement a couple of months ago, where they initially released a calendar 24 and 25 guidance, which was higher than expectations, and then were forced to wind that back reasonably quickly. So this has been a supply side supported rally, and I think that this rally is likely to continue for quite some time. Today's move is just another dip in the road. Moving on to another supply side supported commodity on the next slide, which we've been watching and commenting on for quite some time, and that is the domestic gas situation on the east coast of Australia. Without going too broad, I mean, Australian energy policy has been a slow motion train wreck for the last 3 to 5 years. And the mistakes that have been made are slowly coming home to roost. And nowhere is that better personified other than in the flows from the Bass Strait field, which run through the Longford plant in Victoria. This plant supplies roughly 70% of domestic gas demand on the East Coast. And the CEO of Exxon came out in March of last year. The news article from which is in the bottom left there, confirming that the number of operating wells in the Bass Strait will halve by winter of 2024. So fast forward to the chart, we see we were lucky we had a mild winter in 2023, but those flow rates from Bass Strait are starting to roll off a cliff. And I'm sure they'll manage to scramble together and manage to increase production through the winter months. I mean, that's possibly why they're holding a bit of production back now. But this asset, as you can see on the top of the slide, there was first constructed in 1969. Then they had plants added in 76 and then 83. This plant is over 50 years old in parts, along with a field that supplies it. And eventually this field will run out and there is nothing to replace it. Rather, that gas demand is going to be met by LNG imports, and those imports are going to come at a price which is roughly 30% above the spot price at the moment, and will bring with it all the exposure to global gas price volatility, which has been extreme over the last couple of years. So this is a thematic which has great supply side dynamics, even though, as we see on the next slide, that the demand is forecast to drop. So this is a little bit of nuance which is missed in energy markets and in the energy transition debate. Even though gas demand is expected to fall, as you can see by the dashed red line there, supply is forecast to fall much faster. So that the solid dark green, which falls away quite quickly from 2025, that's basically the Bass Strait field blowing through Long Tom. So we're clearly going to need LNG imports here to meet demand. I mean, this is a function of shutting down incumbent energy solutions before a replacement for them has been completed. So that's likely to result in a spike in prices, and we're well positioned in the portfolio to make the most of that. Onto copper. Would be on the following slide is a commodity which is often talked about, the looming deficit here. We're in a very interesting period of the year at the moment. We're just going into Chinese New Year holiday, so that starts on the 10th of February and will run through to the 17th. And you can see on the graph on the left-hand side there, we're just about to go through the seasonal inventory build globally, basically for all metal stocks, but copper is certainly one of them. But that is happening at the same time as smelter margins are negative. So that's the chart on the right-hand side. So these smelter margins have fallen sharply as a result of a shortage of concentrate from the copper mines themselves. And that shortage of concentrate is a function of the Cobre Panama mine being shut down in November of last year, which by itself was about 1% of global copper supply. And then the downgrades from Anglo American and a number of other downgrades across the copper majors, over the last 2 to 3 months of last year. So that means that the smelters are competing on fees that they charge the miners to convert their copper concentrate into refined metal, and as they compete with each other, they bid in at lower and lower fees, and that's why you get that, and that's where that's what's forming the chart on the right hand side there. But because these smelters are not making any money, they're incentivized to go on to early maintenance, which they have to do at some point, and they may as well do it when they're not making any money. So that means that there should be a shortage of refined metal at the exact same time that this inventory build is starting to take place. So we'll just see how this plays out. But as we come out of the Chinese New Year break towards the end of February, and if that inventory build is not sufficient to keep the world supplied throughout the rest of the calendar year, I suspect the sentiment in the copper market could change quite dramatically. But so that's a sort of a brief view of some of the commodities we like. But I think it's just worth digging down on some of the stocks, because the bottom up investing can result in quite significant alpha. And one of those stocks we've done quite well out of to date is Ora Banda on the next slide. So we've been we've got our position in this stock at around 11 or so cents. It's trading at about 23.5 at the moment, which has been a good run, but there is a lot more to this story, and that was sort of highlighted in the exploration results from Sand King, which were released earlier this week. Now, the market didn't really move on these results, but it should have, and I'll talk you through why. So, you know, this asset has had a long checkered history. You know, it's gone broke at least 3 times that I can remember. It must have had half a dozen different managing directors over the last, you know, 5 or 6 years. But the bloke in the chair now, Luke Cray, is an absolute all-star. He will be, you know, his picture will be up there in shining lights after he's finished his career in the gold mining industry, and he's certainly turned this company around dramatically since commencing work about 18 months ago. But a big part of his success here is a change in strategy. So Ora Banda only has a small mill. It's about 1.2 million tonnes per annum. That means that the operating cost is relatively high, around about $37 a tonne as my best estimate. But if you look at that $37 in grams per tonne terms, it's about 0.4 or 0.38, if you're being picky, grams per tonne gold. So if you're trying to run open pit feed through this mill and your open pit feed is, you know, is reasonable, let's say 1.5, that means roughly 25% of your contained gold is going to your milling costs. If you have a choice about open pit or underground feed going through your mill, which Ora Banda does, you're much better off putting through the higher grade underground feed. So the Riverina underground, which is just starting to go through the mill as we speak today, has a reserve grade of about 4.3 grams per tonne. So if you take off that milling cost, all of a sudden only 9% of your contained gold is going to be attributable to paying for that milling cost. So that means higher margins, and that means better cash flow. So that's the underground feed that's starting now, but what is to come is likely to be from Sand King. So, you know, we've got a very good start on a second underground operation from Sand King in the second half of this calendar year, or more towards the back end, I should say, of the calendar year. But I mean, if this all comes to fruition, then all of a sudden Ora Banda will be able to fill their mill with underground dirt, which means you know, grades will be up circa 70 to 100% on the 2 grams a tonne that they were for the December quarter. So there's plenty more to come here, and something worth keeping an eye on, particularly as the market cap here is around about 400 million. So it's sort of within spitting distance of where it gets picked up by the ETFs, which is you know, probably another, you know, 30 to 40% above where it is today. Sorry, another stock that I think is worth touching on, that I think is interesting, is Brazil Rare Earths on the next slide. So you know, this is was an IPO'd late last year in December. It's probably suffering a little bit of post IPO anonymity at the moment, as you know, you have a big sort of promotional push in the lead up to the IPO, then it occurs, and you know, a lot of people forget about it. But you know, one of the very exciting prospects or points of investment when this company was marketing for IPO was these extremely high grade rock chip samples that they'd found around you know, one of their prospects. They released some drill results underneath those rock chips a couple of weeks ago, and they were absolutely spectacular. I haven't seen rare earth grades as high as what they reported. Some of those grades you can see on the slide there in front of you, 26%, 19%, 20% total rare earth oxides. In one hit, they actually had grades of neodymium and praseodymium, so just by itself, of 5.9%. Now, when I looked on Thursday, putting this slide together, the NdPr price was about $56 a kilo. That's $56,000 a ton, which means the metal in ore value for that piece of the intersection was about 3,300 tons, so $3,300 US dollars per ton, and that's excluding the value of any other rare earths that existed in that particular intersection. So, you know, I don't think it's you know, too exuberant to say that this is likely an industry-changing discovery that these guys have made here. It will take time to drill out, but this deposit is going to create ripples through the rare earth industry, and I think you know, will establish itself at the bottom of the cost curve in time, much like the Rooka uranium deposit is going to do for NextGen. So yeah, that's probably all the high points I'll touch on in the time that I've been allotted. I mean, over calendar 13, if you just flick over the slide, we did, you know, manage to etch out a decent return. If you could just flick over, thank you. So, in what was a choppy year for commodity markets, we were quite nimble. We managed to pick the uranium bull market. We managed to avoid a lot of carnage in the lithium space to etch out a 10.5% return. And that's a lot of the challenge in investing in these commodity markets is, when they run, they can really run hard. And we did circa 150% in the first 18 months of this fund. But in between those times, you really need to focus on preserving value. So that's been the name of the game for the last 12 months. But as we move into calendar 24, interest rates are going to be flat to down. Industrial production is slowly bottoming out. The data from the US is looking better. China data is soft, but I think certainly the government there has to do something about that. Otherwise, they're going to end up in a bit of a feedback loop. And as I pointed out with copper, inventories are very, very low right across the commodity space. It only just takes a little sprinkling of demand, and this whole sector could run quite hard, and we're certainly going to be well positioned for it. So with that, I might hand back to Manny and see if there's any questions.
Thanks, Sam. There's a couple. We'll have to be quick. So just going back to uranium, what are your thoughts around sort of the government's position? Are you of the view that this is going to change soon or not? And particularly, you're based in Perth, I think. So the WA government has got some pretty specific views on uranium. Do you see that changing?
It's going to be a slow burn, I think, in Australia. What Australia does is irrelevant to the price, of course, but just for interest's sake, the more I look at the energy space, the more ridiculous Australia's stance on nuclear technology is. I think it's reasonable to say that there's been a deliberate attempt to hamstring the chances of an emergent nuclear industry emerging in Australia in the way that it's been covered in the CSIRO GenCost report, which focused on on sort of future undeveloped or premature technologies like SMR tech. We should have been asking ourselves, do we want to use the same power solution that France used in the 70s to essentially decarbonize their economy? And it worked a treat, and they're still enjoying low prices of power now as a result of that investment 50 years ago. So I think it's mad not to be assessing it, but it needs to be assessed on a fair, arm's length, dispassionate basis. Okay,
thanks for that. And just one more question before you go. Going back to rare earths, there's a lot of discussion about the different types of rare earth deposits. What is your view? And there's a lot of talk about the clay deposits and and the development of those clay deposits. What is your view on rare earth clay deposits? Do you have a strong view one way or the other?
In the short answer is no, I don't have a strong view. It's a curiosity. I think Sierra, just forgotten the last name of the company that's in Brazil, which is ramping up their ionic clay deposit at the moment, is running into a few issues. So, we'll see if they can be overcome, and then we'll see whether the operating costs which they've claimed, will actually be realised, and then we'll know. Even though I'm in the business of forecasting, I do like an actual. We'll see if their proof of concept, is valid, and whether or not this technology can work outside of China. And then from that, we'll know. But at the moment, I think it's always high risk being first. We'd much prefer to be a fast follower.
All right, Sam. Thanks very much. Well, Sam, thank you for your time today, and have a great weekend. We'll see you back soon.
Likewise, Manny. Thank you very much.